Hey everybody, Chuck Barone here. It's Friday, August the 11th, 2023. Time to wrap up a wild and wacky week on Wall Street. What a week it was, guys. I mean, the markets moved, but not really in a big way. But we got a lot of stuff to talk about because things are happening, right? The inflation picture, wars, government spending, treasuries trying to auction billions and billions of dollars. All kinds of interesting stuff to talk about today. Before I get rolling though, as always, let me welcome everybody to the show. Thank you guys for your support as always. You guys showing up every day, helping us out, liking the videos, hitting us up in comments with questions and fun stuff you guys got every day. It means the world to us, guys. We appreciate it. All right, so let's look at these markets today. Really not a lot in these markets to talk about. A lot of data coming in we're going to talk about, but these markets, stock market today mixed, not much happening. The Dow actually the Dow gains 105 points, which is kind of a surprise because the broader markets got killed. The S&P down 4 points to 4464. The NASDAQ down 93 points, 13,644. So these are way broader markers than the Dow, which is just 30 stocks, which managed to pull out a gain today. So while the Dow looked good, the overall market did not look so great. So there you have the wrap up for the week. The Dow ends up pulling a little bit of a gain out for the week, but the rest of the markets not so much. I think that over the weekend, we'll get some real analysis. Everybody's going to start looking forward to what comes next. I don't think that either day this week, whether it's yesterday's CPI, today's PPI, not good news. Not good news at all, at least for the stock market. Inflation coming back. The numbers higher than they were last month. Much higher than what analysts expected. The market, of course, doing what the market does, trying to spin crap into gold, trying to make us all believe that somehow or another, these numbers are good numbers. They're not. They're not. And the bond market reflects that today. Look at these bond yields. The 10-year spikes 9 basis points. The 10-year now sitting at 4.17%. It was just a couple days ago, it was under 4. The 2-year jumped 7 basis points, 4.89% of the 2-year. So the spread now starting to, the inversion starting to narrow a little bit down to only 72 basis points. I think at one point it was around 115 basis points. The talking heads on Bloomberg and CNBC talking about the yield curve starting to straighten itself out. If that's the case, guys, man, wow, 10-year rates are going to really spike. And I think that led today to some disappointment in the Treasury auctions, which we'll talk about later on in the show. The dollar today, not much, up small. 102.86 on the index, still the king of the hill like always. As a result though, metals having a little bit of pressure. Gold squeezes out a gain today, which is long overdue, up just $1.40, $1,913.20 for an ounce of gold. Silver falls 2 cents, $22.66 for an ounce of silver. So metals basically a flat day, just like the stock market and pretty much everything else today. Oil, also not a big day on oil, moving up 29 cents, $83.11 for a barrel of West Texas Intermediate. I think as we've talked about on the show, oil has broken out, well out now, that trough it was in. We're going to see where it kind of settles and what the new trading range is going to be. It's been pretty volatile, but it looks like 80 to 85 rather than 70 to 75 is going to be the number. We'll keep an eye on that, but that's a pretty big jump in oil. And as likewise, I can always, you can always tell when oil goes up, you're going to see a spike at the gas pumps coming soon, if not already, because it always goes up a heck of a lot faster than it goes down. Bitcoin today, another flat day, down very small today, down just $41. 29,361 for Bitcoin. Still good solid number, hanging in there near that 30,000 level. All of these investment stuff, gold and silver, Bitcoin especially, sitting very close to big resistance numbers. I think that once things get settled down, You're going to see all three of these break through this resistance pretty easily. All right, so let's talk about news today. PPI was the thing. It was the news we were waiting for. We knew it was coming. Well, the numbers came in a little hot today. Disappointing traders. The bond market, as you saw, went crazy. Wholesale numbers coming in up 0.3 just from last month. Up 0.8 year over year. It's 50% higher than analysts had expected. So that's signaling that producer prices are still climbing. As I've been telling you guys all along, those producer prices soon translate into consumer prices. So if producer prices are on the rise, we can look forward to consumer prices rising not long from now, okay? They were talking about where the demand was coming from. It's just a big mess, guys. They want to blame it on services. They want to blame it on workers. Again, they're trying to spin this giant turd burger into gold somehow. These numbers are not good. I think it pretty much locks in the idea of another rate hike next month. We're going to see that quarter-point rate hike. I think that it's pretty much a lock now. Unless we get some incredible numbers between now and September 20th, which I seriously doubt we're going to get. So that would push the overnight rate up to 5.6%, which has been the Fed's terminal rate all along. They announced it a while ago. That was pretty much their target. Another quarter-point increase will get us to that target. I really anticipate that coming now in September. Now the question is just going to be, what's next? What happens next? Is that it then? You think 5.6 will be enough? Or will the Fed have to continue hiking rates this year or into next year? As we know, Wall Street is already factoring in, pricing in, no more increases this year. They're pricing in rate cuts next year. I think the street's going to be disappointed, guys. We talked about this on the show many, many times. How in the 70s and 80s, it took them years and years of high interest rates to get inflation under control. The idea that we're going to be able to now do it in 1 year. Now, they did learn some big lessons from that experience, and they're not making some of the same mistakes that they made back then. But the idea that we're going to be able to just raise rates and get out of this big pain, get out of this in a year or right around a year, well, when it took 10 years last time, it would be pretty hard to convince me that we're going to do it this time in 1 year. So I think that this inflation fight's going to continue for longer than most people think. Rates are going to stay higher, be higher, and stay higher for longer than most people think. Now, don't get me wrong, that, for me personally, that stinks, man. I'm a mortgage guy, as you all know. Interest rates affect my livelihood pretty significantly. I'm probably doing maybe 25% of the business that I was doing during the boom here in town. So here we go. Now rates going to go continually higher with nothing on the market to buy for poor real estate buyers. They're continuing to have prices go up. So now you got higher prices and higher interest rates. Well, not good news for old Chuck in the real estate business, but I'm telling you guys, get ready. Rates are going to be elevated for quite some time. So the idea now being, take advantage of that by stashing some money. When you're earning interest, it's way, way, way more fun than when you're paying interest. I promise you guys that. So get some cash, stash it away, get those 5% yields they're doing now just to have your money sit there. No risk at all. All right, let's talk moving on now. PPI sucked. That's all there is to it. And so did CPI yesterday. So more news today, interesting day. Treasuries today holding another giant auction, $23 billion in 30-year notes, or 30-year bonds, I should say. It was horrible. They barely could get the bonds out the door. Analysts use these wonderful words to describe this auction. So-so, soft, weaker than expected. Now, we've had record inflows into treasuries, $206 billion. $206 billion. Ordinarily, when there's big demand for bonds, that drives rates down. Guess what? Even with all that money flying into those, rates are rising. It's just an upside down world we're living in, guys. And, we do our best every day to try to explain some stuff to you, but Jesus, man. So now you got soft demand in these treasuries. They auctioned off more than $100 billion of treasuries just this week. I mean, with rates going up, the Treasury is going to be forced to pay higher and higher rates to get these bonds moved out the door. We know that they had to have this incredible binge of borrowing after they finally fixed their debt ceiling bullshit. And guess what? It's all coming to pass, man. There's no free lunches, right, guys? Now it's time to pay the bill. It's going to be fascinating to see how long the Treasury can keep pumping these notes and bonds out there at these numbers. $100 billion just this week. Incredible numbers. All right, another quickie before we go. The Federal Reserve, I was reading an interesting article today because a lot of people really feel like the Fed is continuing to flood the market with extra cash and liquidity. That's the exact opposite from what's actually happening. The Fed continuing to drain liquidity out of this markets, starting to rile up some analysts who believe that this lack of liquidity could cause some big issues down the road. But since last June, the Fed has basically reduced the money supply, reduced its balance sheet by $900 billion. As we all know, what they're doing, as these bonds that they're holding mature, they're not buying new bonds and they're pulling that money out of circulation. Well, the Fed balance sheet is still sitting at 7.6 trillion. So it's not like it's, oh my God, a lot of liquidity in this market still. But the Fed, you got to give them props where it's due. They've been staying to their word. They told us they were going to do this, and they are. It's going to be really something because the truth is this would have been 1.3 trillion if they hadn't had to pump in $400 billion with the SVB and the regional banking issue when Silicon Valley Bank went under and First Republic. So the Fed had to pump $400 billion into the system. The number would have been 1.3 trillion. Crazy. All right, guys, so before we wrap up, what did we learn this week? Well, we learned that this inflation fight is going to be a little tougher, a little stickier, a little harder to win than we thought it was going to be. This was the first month in more than a year where inflation rates actually rose and didn't decline. So now the pressure is going to really be on the Fed. What are they going to do next month? Fascinating times, guys. It looks likely to me that we're going to get that quarter next month. Probably, I would not be shocked to see another quarter somewhere later on down the road. So get ready. Higher costs for borrowing, higher payments when you do borrow. All that does is reinforce our message all along. No new debt, guys. Try everything you can do to not borrow money. If you have debt, continue to chip away at it. Even if it's just an extra 10 bucks on the principal, man, it makes a difference. Anyway, that's it for this week, guys. We'll be back on Monday. Hopefully the week will be a little bit calmer than this crazy week finished. Have a great weekend. We got NFL going this weekend. Baby, the Bills are in action tomorrow night. Well, actually tomorrow during the day, but I don't get to see it till night because of the way the NFL channel's showing the shows. But it won't be long, and we're back to Sundays and NFL, guys. Anyway, have a great weekend. Enjoy the time off with your families, your friends. Get away from this markets and crazy government and everything else. Relax. See you on Monday. Until then, guys, take care. Thanks.